Before we dive in, this video is for educational purposes only. I'm a peer sharing insights, not your financial advisor. Always consult a professional before making major investment decisions.
Moving a $300,000 retirement account from an old employer to a new individual retirement account can feel paralyzing. You have a significant sum in motion, and suddenly, you are responsible for where it lands. Before we look at how to handle it, keep in mind that the portfolio breakdowns we're about to explore are for educational purposes and do not constitute financial advice. When a rollover finally clears, a common mistake is to hesitate. Overwhelmed by the choices, many investors leave the entire $300,000 balance sitting in uninvested cash. Cash may feel safe, but it mathematically guarantees a loss of purchasing power. Inflation quietly reduces the value of those dollars every year, meaning your savings will buy significantly less when you finally reach retirement. To preserve the value of that money, you have to invest it. The core dilemma is determining the specific level of market risk that fits your situation. To build out an IRA, you generally use 4 primary tools: stocks, exchange-traded funds, bonds, and real estate investment trusts, or REITs. These tools serve different functions. Stocks and ETFs act as growth engines designed to increase your balance. Bonds act as stabilizers to protect that balance when markets get rough. The exact percentage you assign to each of those 4 assets determines the future trajectory of your $300,000. We are going to evaluate 3 distinct models: an aggressive portfolio, a balanced portfolio, and a conservative portfolio, and run them through a hypothetical 5-year risk lens. Reviewing the trade-offs of these 3 models helps align your emotional comfort level with your financial reality. Let's start with the first model. The aggressive portfolio is built for long-term compounding. This chart shows the equity breakdown. We allocate $180,000 to stocks and $60,000 to ETFs, putting 80% into growth engines. To round out the final 20%, we add a $30,000 slice for real estate through REITs, and a $30,000 slice for bonds. An 80-20 split is built for time. If you leave this allocation untouched for multiple decades, it holds a high probability for growth. However, over a short 5-year window, a portfolio this heavy in stocks will experience volatility. A market correction could cause a steep temporary loss of your principal. By choosing the aggressive portfolio, you trade short-term emotional comfort for potential future wealth. For those seeking a middle ground, the balanced portfolio offers a different approach. In this model, we dial back the equity side to 70%, breaking down into $120,000 in stocks and $90,000 in ETFs. The defensive side expands to cover the difference. We keep real estate at 10% and increase the bond allocation to 20%. Pushing the bond allocation to $60,000 creates a shock absorber for your IRA. When the stock market drops, those bonds help cushion the blow to your total balance. The trade-off for that protection is a lower ceiling for growth. This portfolio won't rise as fast during a strong bull market. This serves as a compromise, pursuing growth while mitigating the impact of short-term market declines. For investors prioritizing stability and income, we look at the conservative portfolio. This chart reduces the growth engines significantly. Equity makes up exactly half the portfolio, split between $75,000 in stocks and $75,000 in ETFs. The other half is defensive. Alongside the $30,000 in real estate, the bond allocation occupies 40% of the total. By shifting $120,000 into bonds, you prioritize capital preservation. Your principal is now more insulated against stock market corrections. The trade-off is that slower growth leaves your purchasing power vulnerable to inflation. A heavy bond allocation may struggle to keep pace with living costs. Look at how these choices play out on a 5-year timeline. The aggressive model shows a wide range of possible outcomes, while the balanced and conservative models show progressively narrower, more predictable bands. The differences in these 5-year ranges demonstrate that your risk level is tied directly to the moment you plan to withdraw and spend the cash. Your timeline dictates your allocation, starting with years to withdraw. 15 or more years aligns with the aggressive outcome. At 5 to 15 years, follow the balanced outcome to ease risk. Under 5 years, the conservative path prioritizes principal safety. Aligning your timeline with your portfolio prevents the mistake of selling during a market crash because of short-term panic. Define your specific withdrawal timeline, consult a fiduciary if necessary, and commit to the strategy that matches your $300,000 rollover.
Hit subscribe for more wealth-building tips.